Hello there. Welcome back to my channel. In this video, we're going to answer a question from the question paper November 2024. So we are going to look at the preparation of the statements of comprehensive income. So moving on to our question, this is going to be our question 6, and it reads the following relates to the financial year of Emeka Traders CC with members Emeka and Emelda, which ends on 20th February 2023. So all the required part, first part is saying prepare statement of financial position on 20th February 2023 with 18 marks. So we're going to start on the first part of 6.1. So we're going to see that you are given an extract from the pre-adjustment trial balance of MB CC on 20th February 2023. So you just need to browse through the pre-adjustment trial balance that we have. So moving on to the next information, we have got additional information, and that you also need to go through everything that you are given in additional information before you start to answer the question. And this is going to be the last additional information that we have, which is additional information number 9. So going to our other section, you see that this is going to be our statement of financial position on 20th February 2023. So we are going to start on the section of non-current assets. So according to information given, we can see that we have got landed buildings, vehicles, and equipment being non-current assets. So we are going to give a description of property, plant, and equipment. So we're going to say then obviously we need to add all that current assets that we have representing our property, plant, and equipment. So if you try to go back, you'd see that we have got information of land and buildings as our property with 322,000 vehicles, 72,000 equipment, 66,000. So you're going to see that land and buildings we check if you've got any additions or subtractions in terms of land buildings. That is land buildings that was purchased during the year or that was disposed during the year. So if you go down, additional information, you can go through everything, but I don't see that we do not have any additions or subtraction. And you can take note that our year is ending 28th February 2023. Very important for you to identify your financial year at the beginning of answering your question. So see that our year is starting 1 March 2022 to 28th February 2023. So this is going to be our year, and the balances that we are given is on 28th February 2023. Very important for us to take note of that. So what we have is we are given land and buildings 322,000. So we're going to check this figure, 322,000, and be part of our calculation under that current asset, under that current assets. So we are saying brackets with 322,000. And then next we have got vehicles. So on vehicles again, we go to the information to check information about vehicles. We see that we have information number 7. It is the CC's accounting policy for calculating depreciation vehicles at 20% per annum according to diminishing balance method, equipment at 10% per annum on the cost price. So we are concerned about our vehicles. We want to calculate for vehicles. So you need to, so the assumption that we have is that the figures that we are given here are figures at the beginning of the year. So we need to calculate a depreciation for the year, and then we find the net book value or the carrying value for vehicles for the current year. So what I'm going to do is, according to information given, is 20%. So we are going to use our 20% as our rate, but it's using the diminishing balance method. So we need to calculate that. So we are saying using the diminishing balance method, remember the formula that we use using diminishing balance method is the same as the carrying value method. So the formula that we use says a percentage times carrying value. Where carrying value is equals to costs minus accumulated depreciation. So we need to go back to the question and try to find out the cost of vehicles. Remember, we are calculating for vehicles. So if you go to the pre-adjustment trial balance, you're going to see that the vehicles, we have got 72,000, which is representing the cost for vehicles. Then accumulated depreciation, we have 16,400. So you're going to say 72,000 minus 16,400, then you get our carrying value. So basically, if you come here, 72,000 minus 16,400. So we are saying carrying value. For the carrying value, we are saying 72,000 minus 16,400. And if you calculate there, you're going to get it as 55,600. So for our depreciation for the remember the rate that we are using is at 20%, 20%. So we are saying 20% is 20 over 100 times 55,600. Remember, 55,600 is carrying value. So we are now employing the formula that we have here. So we calculate there, you get your figure is 55. You can just try to calculate. You're going to get it as 11,120. So this is going to be depreciation for the current year. So remember the figure that we are supposed to enter here is as the final figure for vehicles, it's going to be the carrying value. So to get our carrying value, we are going to say the costs that are accumulated depreciation. So our costs, remember, it's 72,000. So we're going to say 72,000, and then we subtract the 60,400 that is already there. And then we subtract again for the current year, we've got 11,120. So we do that, we'll be able to get 44,480. So this is going to be your carrying value for vehicles. So this is the figure that is supposed to come here. So you're saying plus 44,480. So remember, we also have to calculate carrying value for equipment. So for equipment, according to our additional information, we use 10% per annum on cost. So this is the on cost price. So this is the cost price method that we are using, or the straight line method, which says percentage times cost. So we are now saying the cost price method calculating depreciation. We say percentage times cost. So basically, we have our cost as for equipment is 66,000. So we are saying the percentage that we have is 10%. So we are saying 10%, which is 10 over 100 times 66,000. Obviously, you're going to get your answer 6,600. So remember, we need the carrying value, which says cost minus accumulated depreciation, of which our cost is 66,000. So we're going to say 66,000. Then accumulated depreciation, we take the depreciation that we are given in the pre-adjustment trial balance, which is for equipment, it's 13,600. So we subtract that one, 13,600. Then we also subtract the depreciation for the year, is 6,600. And then we get your answer is 45,000, 45,800. So this is what we have for that part. So we take our 45,800, and this is the figure that is going to our statement of financial position. So here we are saying plus the figure that we got is what we was 45,800. You can just maybe try to confirm. Yes, 45,800. So 45,800. So from there, we can now be able to add the three figures that we have here, brackets, to get the total that is supposed to come here. If we add the three figures, we're going to get 412,280. 412,280. So that's the same figure that is going to come here, representing the total for that current asset. So here we have put also 412,280. So from there, we move on to our current assets. So for our current assets, obviously, we start with the figure for trade and other receivables. So here we have got trade and other receivables. That's the first, obviously, item that we put there. So trade and other receivables, I will check for the figure for the debtors control. That's what we have. We have got 40,000. The figure for our debtors control, we are given it as 40,600. And remember, we have got other receivables. So let's take note. Um, Components of trade and other receivables. Trade and other receivables, obviously, we have debtors control. And then we add if we have got prepayments of expenses, we are supposed to add them. Also, when we have accruals of income. So if you add this, you're going to get the total for trade and other receivables. So obviously, the figure for debtors control, we have identified it already. So we check for these two if they exist in our question. So we go back there, we check what figures do we have that can lead us to that. So we can try to see according to information given. We can obviously go to our nominal account section, try to see if we have got everything that we are. Remember, we have got deferred expenses here, which is also part of our current assets, but we're going to enter it separately. Then we check in additional information. What do we have? Let's try to see. And remember, you've got provision for bad debts must be adjusted to 5% of outstanding debtors. So remember, the level of provision for bad debts is supposed to reduce the amount of our debtors control. So we calculate it again. We say 5% of the debtors amount, 5% of the debtors amount that we are given there. We remember the debtors control figure that we have is 40,600. So we are going to say 5% is 0.05 as a decimal. And then we multiply by the debtors control figure that we have as 40,600. get the level of provision for bad debts. So we can just maybe try to calculate that one. So we're going to get 2030. So this is the figure for uh, level of provision for bad debt for the current period. So the whole amount is supposed to be subtracted here to reduce the amount of data. So in brackets, we are saying the data's control figure, remember, it's 40,600, then you subtract 2030. So we are saying 40,600 subtract 2030. And then we check the check information if you have got prepayments of expenses or accrual of an income. So if you go down, you'd see that if you go to item 6, so on item 6, it reads a property to be rented to a melder for a period of 3 months for business purposes. The rent of 3,600 has already been paid. The rent of 3,600 uh, has already been paid. So remember, it's a property which needs to be rented from it's supposed to be from a melder for a period of 3 months. So we are renting from a melder for a period of 3 months for business purposes. The rent of 3,700 has already been paid. So it means we have already paid. So remember, rent, this is a rent expense. And we have already paid 3,600. So it means this becomes a prepayment of an expense that we have made. And remember, prepayment of expense, we classified it as part of trade and other receivable. So it's here. So we are supposed to add it, 3,600. We add it to the figure that we have here for trade and other receivables. So we add 3,600. So from there, we can now be able to get the total for trade and other receivables. So it says 4,600 minus 2,030 plus 3,600. And the final figure that you're supposed to get is 42,170. And then from there, we check other current assets that we have in the question. We go to our pre-adjusted trial balance. But I'm going to see that we've got trading inventory here, which is 36,700. So it's also part of our current assets. Remember, the trading inventory that has to be part of the current assets is the closing trading inventory. So if you come here, you would see that this balance is all that we are given in the pre-adjustment trial balance is balances as at 20th February 2023, which is at the end of the year. Remember, the year is ends on 20th February 2023, as indicated at the beginning of the question. So we just check that. So you're going to see that in some questions, when you're given a list of balances, the closing inventory figure might be in the additional information. But in this case, we can just take this one, is since we are given that this is the end of the period. So we are saying 36,700. So we're saying trading inventory. Trading inventory is 36,700. Then from there, we check for other current assets that we see in the pre-adjusted trial balance. We go down, checking. We have got bank. Remember, bank is part of cash and cash equivalents. So we are also supposed to know components of components of cash and cash equivalents. Uh, we, we are talking about the balance of bank. If there's cash, it's supposed to be part of that. Talk about cash float. Talk about petty cash. Also supposed to be a part of components of cash and cash equivalent. So if we have also short-term deposits, it's also supposed to be part of that. So these are components of cash and cash equivalents. So according to our question, we see that we only have bank. We do not have an additional component of cash and cash equivalents. So just going to take our 36,600 as a representation of our cash and cash equivalents. So we come here, we say cash and cash equivalents. So in the exam, obviously, you have to write in full cash and cash equivalents. The same applies to trade and other receivables. You just write in full trade and other receivables. So cash and cash equivalents are the figure that we got was 36,600. So we're saying 36,600. And remember, we also have this figure that we said we're also going to be part of our current assets, which is the figure for deferred expenses, 200,000. Remember, our explanation or the description that we give in terms of our deferred expenses. Our deferred expenses, they represent payments made in advance for goods or services to be received in the future. So that's why we didn't include it under trade and other receivables because it's not uh, a receivable in terms of trading that we have inside deferred expenses. So we're classifying it on its own. So we have got 200,000. So we're saying deferred expenses. So we also have deferred expenses here. Remember the figure that we got is 200,000. So from there, we have exhausted all the current assets. So we need to add. So we are going to close so that we can show that we are adding everything that is inside the box. So we add everything that we have here and total should come in. So we are saying 32,170 plus 36,700 plus 36,600 plus 200,000. Then the total should come in line with our current assets. So the total that we're supposed to get is 115,470. So remember, we are supposed to get our figure for total assets here as indicated total assets. So total assets is equal to non-current assets plus current assets. So 412,280 plus 115,470, you get your figure for your total assets, which is going to be 727,750. So we can take note also that according to the accounting equation, total assets is equal to total equity and liabilities. So that's what we have. So it means is the figure that we got here, 727,750, is also the same figure that is to come at the bottom here as our total for equity and liabilities. So the total should be the same. So so we go to the equity and liability section whereby we're going to start with our members funds. And we are going to start with our members funds. So the total for members funds is supposed to be here. So beneath that, we're going to list all the members funds. So if you go, we see that we've got accumulated profits as pre-entered as part of members funds. We're also going to check the figure for members contributions in the present. So if you go to the pre-adjustment trial balance, you see that members' contributions, you're given 300,000. So we are saying here we've got members' contributions. And the figure that we have is 300,000. So to get the total for members' funds, it should come here. You're saying 300,000 plus 310,120. You get your figure is 610,120. So basically, that's what we have for that part. So moving on to the next part, we have got a non-current liability section. We are here. So the total should come here also. So for before we move on to non-current liabilities, we can correct our figure for accumulated profits. The pre-ended figure, we can just correct this figure. It's supposed to be 214,120. So we have 240,120, which if we add at 300,000 plus 240,120, we are going to get a total for members' funds of 540, 540,120. So we have 540,120. So this is what we have for that part. And then we move on to non-current liabilities. So non-current liabilities, we take note, we have got mortgage bond that we have, which is 90,000. But this mortgage bond, if you go to additional information, you'd see that you go to additional information number 9. It's saying the mortgage bond was negotiated on 31 December 2021 on these conditions. Repayment installments of 30,000 per annum starting 31 December 2022. So 31 December 2022, and our year is ending 20th February 2023. So it means this 30,000, we have to subtract it. It's a repayment. It reduces the mortgage bond balance. So we're going to say 30,000, we subtract it from the figure for mortgage bond 90,000. So basically we're saying 90,000 and that's 30,000. We do that, we see that we are going to get a figure of 60,000. So this is going to be our mortgage bond. So we come here, we have 60,000 for mortgage bond. We are saying mortgage bond 60,000. And then we check other current liabilities that we can have in the question. If you go to our pre-adjustment trial balance, we also have a loan from members. We've got loan from Emeka, 1 January 2023, and then loan from Emelda, 31 October 2022. But both of them, they are loans. So we've got 20,000 plus 60,000. So if we say 20,000 plus 16,000, you get a total of 36,000. So this is the total for loan. So this is the figure that we are going to also put here as loan. We are going to put them as loan from members. So loan from members, remember we got 36,000. So if you add the two figures, 60,000 plus 36,000, you get your 96,000. As a representation of our non-current liabilities. So From there, we move on to current liabilities now. Remember, the first figure that you're supposed to put other current liabilities is trade and other payables. Trade and other payables. So obviously, you have to calculate it by taking the figure for your creditors control in the pre-adjusted trial balance. So we come here, creditors control figure, we have it here with a figure of 53,145. So that's the figure that you are going to first put here, 53,000 145. But if you check, you are going to see that in the question. Remember, we are also supposed to check if you've got other payables. Other payables consist of accruals of expenses and also prepayments of income. So check enter information if we have such accruals of expenses and accruals of expenses and prepayments. Prepayments of income. So, but you're going to see that we've got item 4. It says the water and electricity account for February 2023 has been received but not paid. So this is an accrual of an expense, which is electricity, 485. So we're going to add them in brackets whereby I say the creditors control figure that we have is 53,145. Then we add the accrual that we have in there, which is 485. So we check again if we have got any other accrual. But if you go down, you'd see that we have information on the last point, which is saying outstanding interest to be taken into account. So it means there is an outstanding interest. And outstanding interest becomes an accrual. Remember, interest is an expense. So we need to calculate it. We need to calculate. So if you go to the pre-adjusted trial balance, you'd see that under the nominal account section, we have got interest on mortgage bond. That's the interest that we are going to deal with at this moment, 11,500. So this is the actual interest that was paid on mortgage bond, but it doesn't mean it's the interest that is supposed to be for the period. Remember what the matching principle says. We should record what belongs to this current year, and what doesn't belong to this period. We do not have to record it in the current period. That's why we adjust for prepayments. We remove prepayments because we are saying the amounts were paid, but they do not belong to the current period. Subtract them accruals we add to say we are saying we need to pay a certain amount, but it belongs to the period. So in this case, we need to find out what was supposed to be the interest for the period. Then we compare with what was paid to see if we paid more or we paid less. So if you go to the mortgage bond, you'd see that it's 90,000. But if you go there in additional information, you will see that you are being told that interest at a rate of 11.5% per annum is payable. So we now know that the interest is 11.5%, but we are also told that repayments in installments of 30,000 rands per annum starting 31 December 2022. Remember, our year is starting 1 March 2022 to 28 February 2023. So what does it mean? It means we have got a period of we have got 2 periods because the repayment was made 31 December 2022. That made our mortgage bond to be 90,000. So we need to calculate the interest for the 2 periods, that is before and after. Before at the repayment and after and after the repayment. So what we are saying is this balance that we have 90,000, the assumption is that it is balanced at the end, which is 2023. So it means on 31 December 2022, it was 90,000. It was 90,000 plus 10,000 that was repaid, get you 120,000. So for the first period from 1 March 2022 to 31 December 2022, it was 120,000. And then for the remaining months, which is 2 months, January and February 2023, it was now 90,000. So we need to calculate the interest in two phases, whereby you're going to say 11.5% is 0.115 as a decimal. And then we multiply by 120,000 before the repayment. And then we multiply by the proportionate number of months that applies to the 120,000. It was from 1 March to 31 December, which is the whole of March, April, May, June, July, August, September, October, November, December. So we have got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we've got 10 months. So it's going to be 10 over 12. So we multiply by 10 over 12 months in a year. So we calculate it like that. We see that the figure that we are going to get is going to be 11,500. So this is only for 10 months. Then for the 2 months after the repayment, when now the mortgage amount was now 90,000, we are now saying 0.115 times 90,000. And it was only applicable for January and February 2023, which is 2 months. And multiply by 12 over 12, by 2 over 12, sorry. And then the final answer that you're supposed to get is 1,725. Then we add the two to get the total interest that is supposed to be for the year. 11,500 plus 1,725, we get 13,225. And then you compare with what was actually paid for interest, which is 11,500. So if you come here, we've got 11,500, 11,500. And then we are comparing in this figure, we see that we paid less than what was supposed to be paid. So we've got an outstanding amount, which is going to be an accrual of an expense. So we say 13,225, subtract 11,500, and we get the amount of the accrual, which is 1,725. So basically, this is what we have. And this is the figure that is going to also increase the amount for trade and other payables. So we are saying plus 1,725. So from there, we can now add so that we can get the total. So if we add, we're going to get 55. You're going to get your answer is 55,355. So we can try to put our figure here is 55,355. Then other that if you go to your entire information, you are going to see that information given here under the mortgage bond, you'll see that we have got repayment total, which is 30,000. Repayment total is 30,000, and also we have got an outstanding interest amount. So outstanding interest amount represents the interest capitalized. So to get so it means that if you have got interest capitalized, it means there is going to be a creation of of a short-term loan or short-term portion of loan, short-term portion of loan. So my explanation is if we have got an outstanding interest amount, it is called interest capitalized. And when you have such a scenario, it means we are supposed to have a short-term portion of loan. And we calculate it by saying this is equal to uh, total repayments minus interest capitalized, of which we have already calculated our interest capitalized is 1,725. So we are saying 1,725 is our interest capitalized. Then our total repayments we are given it is 10,000 per annum, which is so it has to be per annum. So you've got 10,000. So we subtract the two. You're going to see that the figure that we are going to get for short-term portion of loan is 28,275. 28. Can just try to confirm that calculation. Thereby you're saying 30,000 minus 1,725. 20,275. So this is again going to be the amount that is going to come here as our short-term portion of loan. Which will go to 20,275. So this is what we have for that part. Then we also have the issue of other current liabilities that we can identify in the question. We can just try to see if we have got other current liabilities that we have. Go to our pre-adjusted trial balance and try to see if we have other that we can include. Go to additional information. So if you come here, you'd see that we have got a distribution of net profit set for 34,000 rands according to members' interest. So this is a distribution. This is going to be distribution to members. So it's going to be part of that of our current liabilities. So we're having distribution to members. We got 34,000. Then from there, we can now add 55,355 plus 20,275 plus 34,000. So you're going to see that the total that we are supposed to get is 117,630. We can just try to confirm that calculation. So 117,630 is the total for current liabilities, which is supposed to come here. 117,630. So remember, we are supposed to add three figures to get our total equity and liabilities, which is supposed to come in. And then at this point, we can also try to close since we are going to add everything there. And at this point again, we can close. At this point, if it was possible, we can also close. because we are adding everything that's inside to get the total. We add this one, we get this one. So this is what we have on that part. And then uh, the total figure that is going to come here is going to be total equity and liabilities. This is going to be total equity. The equity liabilities. And then we are adding the three figures, 54,120 plus 96,000 plus 117,630. So if you add the three figures, you're supposed to get the second balancing figure, which is supposed to be 727,000. 750, and obviously we try to confirm that calculation. So this becomes your final answer. And if you check here, you'd see that this is the same figure that we have here. And obviously, we need to also close here, so that this is your first balancing figure. So we can see that this explains the statement of financial position explains the accounting question, where we're saying total assets is equals to total equity and liabilities. So these are the two balancing figures that we have. As we have the first balancing figure and the second balancing figure. So basically, this is what we have, guys, according to the statement of financial position section of the question 6 of November 2024. Other parts of this question are going to come. Let's stay tuned for more videos to come.